Hi everyone and welcome to our training for today. In today's training, we're going to be looking at become a pro market analyst, learn the secrets to picking perfect trading entry. Well, it's important to understand or to get good at picking your entry into the markets because this could mean success or failure. So when you enter the market, it has a long way to go as to how successful, how profitable you would be in the market overall. So being able to pick, tops or close to the tops where to sell and bottoms or close to the bottoms where to buy. Not necessarily close to the bottoms or close to the top, but areas where the market is doing its turnaround to buy. So if the market is, you want to buy a market that is selling off, and then you want to buy a market that is buying off. Now, so that's what we're going to cover on today's training. As usual, this is me. I'm going to be your host, and Alvin Alexander. It's important to put out the disclaimer when it comes to forex trading. There are risks associated with trading, and so it's important that you get accustomed to it. This is the content of what we'll be covering most today. So first, we'll begin by looking at multiple time frame analysis. Then we'll look how we can combine that with counter trend line trading, and then finally, we'll wrap it up with trade journaling, the importance of trade journaling. And then I'll give you a free trade journal Excel spreadsheet that you can use to support your journaling. Let us kick off by looking at multiple time frame analysis, or MTFA as I like to call it. So multiple time frame analysis is a process whereby we use multiple time frame, just as the name implies, to analyze a particular currency pair. This is because what you see going on a lower time frame is a reflection of what the higher time frame is doing, just like this two system shows here. So it is the same chart that you're looking at here, but this is the higher time frame. And then on the higher time frame, you have this short, and the higher time frame, this small movement down is what is this on the lower time frame. So if you understand, looking at this, you know that the market, for example, this market is going up. On the higher time frame, it looks like it's going up. On the lower time frame, it looks like it's coming down. So being able to understand where you are in the stream of time will give you an insight whether you should buy or sell. So in this kind of case, it might not probably be the best opportunity and best advice to sell the market here. But on the lower time frame, it looks like it's still going down. Let's sell. When you combine that with the higher time frame, you can see that maybe you should sit out this one, or maybe even possibly there's a buying opportunity. Now we're going to look at the chart to show some example of this. And looking at a higher time frame will help you to gauge overall market direction. So by higher time frame, we're looking at things like the monthly time frame, the weekly time frame, and the daily time frame to look at the overall direction of the market. So this is for swing and day traders. And if you're scalping, the higher time frame for you will be like the 4 hour time frame and maybe the daily time frame. So let's let's look at our chart and see how we can use the chart to explain the time frame analysis. Okay, so let's use this USD pair here. So if you look now on the daily time frame, you can zoom out and you can see that long term spanning several years. If you look at the time here, this is 2016. So since 2016, this market has been in a downtrend. Since way back as 2016, this market has been in a downtrend. So although you don't need to, look that much for behind because we're not trading that. But even if you look at the long term, not so long, this is since March. You could see that the markets, or since January actually, the pair has also been in a downtrend. So the market we're looking at is a bearish market. So long term, we've analyzed that okay, this market is in a downtrend. It's bearish. You can zoom in a little more so that you could still see the direction, but you could see how the market is moving lower. So moving lower. So we've established that the market is in a downtrend. But now if you go to something like, let me say, the 30 minutes time frame, you would notice that that same market that is in a downtrend in the long term is actually, it looks like it's an uptrend on the 30 minutes chart. You can see it is moving higher and higher. So if somebody uses only the lower time frame to do your analysis, You're like, the market is going up and up, so let's keep buying. You would now find yourself, if you continue at that, buying the market and at an area where the higher time frame is suggesting to sell. Know if you get that. So you want to use the higher time frame to establish the overall market direction, to figure out what is the market doing long term. And then once you have that figured out, you can add your moving average and draw your trend line. So this is the 200 exponential moving average, and as you know, it just gracefully leads the direction of the market. So as long as price is below it, the market is bearish. So you can see price is way below it. So the market is actually in the bearish market. So long term, we have established that the market is bearish. Now, short term, like we saw on the 30 minutes and the 1 hour time frame, the market is bullish. So I remember if we're selling a pair, we're looking to sell it at a high price. And if we're buying a pair, we're looking to buy it at a low price. And so when you look at the lower time frame, you can now see that okay, maybe the price is now coming back up to an area of interest. So in this case, let's say we have this area of interest here, where the market is pulling back up to, and then you have, based on the fact that long term you've established that the market is bearish and you're looking for opportunities to sell. Remember, in a bearish market, once you've established that the market is bearish on the long term, market is bearish, you're looking for opportunities to sell. And once you've established that the market is bullish, you're looking for opportunities to buy. So if you see the market make its move on the lower time frame, come back to an area of interest, let's say for example this in the bearish market, then it starts forming some kind of price action that shows rejection. That might now indicate some kind of buying selling opportunities to sell the market at this price. And this is how you combine multiple time frames together. It's the same thing with all the pairs. You can apply this to any pair. You want to look at the overall long-term time frame to see what the market direction is. Now, so in this case, AUD USD, long term, you can see that the market is bullish. You can see how it is making higher highs and higher lows. And this is way back since in March of this year. And you can see the market heading higher. But short term, if you zoom down to zoom into the 1 hour time frame, you would see that the market is bearish. On the long term, it is bullish. On the short term, you could see the market is bearish. Now, if you don't use multiple time frame analysis and you decide to start selling this market voraciously, you might find yourself in trouble. Because on the longer time frame, when you look at the daily time frame, for instance, you would notice that the market is actually coming back to an area of interest. And like I have here on this chart, I'm actually looking for opportunities to buy this market around this level. So if you don't do multiple time frame analysis, you find yourself selling the market where you should be looking to buy. And then if you don't do in the same way, you could find yourself buying the market when you're looking to sell. So even though short term, like the 1 hour time frame or the 4 hour time frame, the market is bearish, as you can see, going down, it may not necessarily be a good buying opportunity. So what you're probably looking for is when you combine that with the higher time frame, you can now see, okay, this is an area to buy. So in this case, for example, I mean, I look at what happens when the market gets here and how it rejects up from here. So once it rejects up and start, heading higher in the direction of the overall trend, that might now provide us with favorable entries and favorable opportunities to start buying in the direction of the overall market trend. Just like another example is also the USD JPY that we showed. So in this case, you can see, let's say the market is heading higher. But if you look at this price structure here, let's say the pin band, the bullish engulfing, the bearish engulfing, short term, you could see that the market may form a rejection here. But as long as the price is still above this trend line, it is still bearish. This trade was taken for a demo purpose, for a training purpose. So you this is how you combine multiple time frame. So you use the higher time frame to figure out the overall market direction, then combine that with the lower time frame to enhance your trading. We now go to the next part of our pro techniques, which is called counter trend line trading. Remember, in this last one, this one we just talked about, we use multiple time frames to figure out where we are in the stream of time in relation to the market. And then if we're saying that the market is overall bearish or overall looking to head lower, we can now go to the lower time frame to figure out possible areas where the market will likely do its turnaround. Now, once we have that, this is where the next part comes in, which is the counter trend line trading. This is one of the most powerful trading technique as far as I'm concerned, that is not used enough because most people don't either they don't know about it or they don't know how to do it to do it properly. If you understand how counter trend line trading works and how you can use that to your advantage, then you would that alone could probably enhance your trading overall. Now let's go to the chart and see if we can figure out that. Let's show several examples of how that works. Now, counter trend line trading, just as the name implies, it means you are looking for a break counter, of the trend. Now, let's pick a market that is trending. This market, okay, let me use USD Use this okay. So we have a clean chart here as well. And in this currency pair, you can see that the market is also bearish because the market has been heading lower. You can see how the market has been staying below, you know, it has been staying below resistance. So this shows that over in a longer time frame, the market is bearish. You can also have another trend line like this, which has also served to keep price lower. So you could have this here. You can see how market has been staying below price. Now, this will figure out the first part using multiple time frame analysis to say that okay, the market long term or mid term, both long term and medium term is bearish. Now, in order to figure out anything, remember if you figure that the market is bearish, we're looking for opportunities to sell. Now, in order to figure out good places to enter the market, we might now decide to move to the lower time frames, maybe the 4 hour time frame or the daily time frame to figure out our entry. So let's use the 4 hour time frame in this case. Remember, we said the market has been bearish. So if the market is bearish, we're looking for opportunities to sell. What's make my chart? We're looking for opportunities to sell. Okay. Now, look at this. Remember, we are waiting for areas for the market to get areas of interest before we try to, get into the market. We wait for the market to move. The key to profiting as a trader, to being a successful trader, is not to try and guess the market. It's not to try and, outsmart the market. It's actually to try and follow the market. Figure out what the market is doing and allow the market do its thing. Then flow in the direction of the market. So you don't want to flow against the tide. You don't want to flow against the current. You want to flow in the direction of the current in the market, especially if you're a newbie trader. When you get more advanced and you've gotten more experience, you can now start trading. You would have figured out how to, you know, when the trend is about to reverse and how to trade it properly. Waiting for the market to pull back in the direction of the trend. Now, remember from multiple time frame analysis, we say we use the higher time frame to figure out the overall market direction. Now, in this case, you can see that the market is bearish. So the market is bearish. So in a bearish market, we're looking for opportunities to sell. So what that means is this. Once we figure out the overall direction of the market, then we're waiting for the market to pull back. So remember, if the market is bearish and it is already very low, that probably is not a good place to buy or to sell, sorry, because the market would usually pull back and make a wave pattern. So in that kind of situation, when the market is bearish in a downward channel or in a down is in a downtrend, and it's making a pullback, you know that since it's a bearish market, there's a high probability that that move higher is just a a pullback, a temporary retracement that would now be corrected. So when the market start pulling back in a bearish market, when price start pulling back in a bearish market, that could now give you an insight to trade the counter trend line. And so this is where you now, probably use the lower time frame. So let's go to the lower time frame and look for the counter trend line breaks. Remember, we're looking for a market to be trending. It works both in the trending market and in the sideways market. Now, overall, we know that the market is bearish. So when the market pulls back, so when the market makes a move, by pullback, I mean the market makes a move higher, there's a strong likelihood that it would head lower. And so what you want to do is, especially when this pullback align with an area of interest, like an area of support and resistance, in this case, an area of resistance, they provide excellent entry opportunities. Now, look at this market. This is a clear trending market. The market is bearish. You notice that when the market pulls back to a level, it drops. If you draw a trend line here that connects the lows and then trade the breakout of the trend line, you would have good, favorable trade opportunities. If you look at the trend lines I'm drawing, you have the market pullback. So when you have the market pullback in a downtrend, you have the market pullback in a downtrend and breaks out from that counter. Remember, this trend is a counter trend line because the overall direction is down, but this trend line is is upward. That's why it's called counter trend line. So the overall direction of the market is bearish, but this trend line is upward, and it is in a much lower time frame, as in a much lower range. So when you have market pullbacks like this, you see, once it breaks the trend line, that's the counter trend line, it usually rallies to in the direction of the overlaying trend. So you see this, you can see how many trading opportunities lie within here. Now I'm just drawing all of the trend line so you can see it. Now notice the market pulls back, you draw your trend line. Once it breaks the trend line, you enter selling. If you miss that one, you'd also have another opportunity. The market pulls back again, and then makes a move higher. You draw your trend line, an aggressive trend line, and then once it breaks the trend line, you enter in the direction of the overlaying trend. So as long as the market keep making, in this time you can see it keep making lower lows and lower highs. So lower lows and lower highs. As long as the market is still making lower lows and lower highs, this pattern would continue to profit you. So if you've entered here and you sold the breakout, the counter trend line break, and then when you have another counter trend line, you sold it again, you have another counter trend line until you have the market move higher than the previous high. Remember, since it's in a downtrend, we're supposed to be seeing the market make lower lows and lower highs. So we're supposed to be seeing lower lows and lower highs. But at this point, it refused to make a lower low. And instead, it make a higher high because this high, the new high it made now became higher than the previous one. So that counter trend line technique is now, you now pause on it because the market has broken structure. So this break of structure ends that trade. So in this 1 hour time frame, remember the overall direction of the market is bearish. And so we start trading the counter trend line breaks. Once you have a trend line breaking forming in the opposite direction of the overall trend, you can trade the counter trend line breaks. You can see the counter trend line breaks over and over again. So trading the breaks of the trend line. So if you had done that, you would have, this is what, 170 pips. But if you had traded that, you would not have gotten 170 pips. You probably have gotten two times that value. That's if you trade each of the bricks. Now, you don't want to go and overtrade. The one thing you do not want to do is overtrade. But when you get good at it, for now, you want to stick to trading, just trading it once, trading a pair because you probably would have not gotten the technique or gotten better at it. So you don't want to risk too much. So what you want to do is trade the counter trend line breaks in the direction of the overall trend. Remember what we first talked about is multiple time frame analysis. So you use the higher time frame to analyze the overall direction of the market. And then you use the lower time frame to figure out entry. In figuring out your entry, you use counter trend line breaks to figure out areas of high probability in you because you know the market is bearish. And so there's a higher likelihood of continuing in that direction until the market breaks structure. So you can see in this case now, if you have price, and this is a daily time frame, so this is a much higher trend line. If you have price break above this trend line and this structure, it would convert this bearish market to bullish, especially once you have price make a high that is higher than this one. So once you have another higher high, so if you have the market make a move which is higher than this previous high, and then start moving up in that direction, then it would have broken structure. And then instead of looking for bearish opportunity, we start looking for bullish opportunity. A lot of people just want to know, how to take trades. But knowing how to take trades is the easy part. You need to understand the first thing you want to do is you want to know is what is the market doing? Where is the market headed? Where is it headed in the long term? Okay, what is it doing in the short term? Once you figure out where the market is headed in the long term, you can now say if it's you can now know if it's a good opportunity to buy. Think about buying. The market pulls back to this region, head high to this region. And without looking at the overall trend, you decide, oh, the market is bullish. Maybe you're looking at the lower time frame. So if you look at this on the 1 hour time frame, what you see is this. So you have so somebody can look at this and be like, wow, this is the market is now fully bullish and decide to trade this to the moon. Yes, if you trade this short term, you might profit. I actually traded this short term. Now, this is also counter trend line break. The market has now started making higher highs. So after making these highs, this high here, the market is now in a temporary, low level uptrend because this is a 1 hour time frame. So on a medium term or a short term, the market is now bullish. But you know overall the market is bearish. So if you're a new trader, you don't want to be trading against the trend. So it's better for you to wait and then wait for the opportunities for the market to move in the direction of the trend. And that's the reason why there are several other currency pairs. So if one particular currency pair is not doing anything interesting, you don't have to force it trade. Leave that currency pair and look for another one that is favorable. Now, if somebody is trading a counter trend line against the trend, so if the market gets to this, remember this level you're seeing here is our trend line on the daily time frame. So this trend line on the 1 hour time frame, this is what it looks like. Now, if market continue making this bullish move up to this point, somebody else who doesn't analyze multiple time frame might actually think that the market will continue making its move higher. And in truth, the market could do that. But it also very likely could, reverse from that area and start heading lower because on a longer time frame, the market is bearish. So understanding how to use multiple time frame can only aid your trading. And then perfecting your counter trend line trading would only go to perfect your entry. So see what it does. Multiple time frame analysis, the MTFA, I like to call it, helps you to understand. It gives you an insight into the overall market movement. Then combining counter trend line trading with your price action techniques that we've talked about and that we've learned, as well as support and resistance, can now enhance your level of your probability of win. So your win rate would go higher and higher. If you look, the market, just as we talked about, when the market breaks a level, it usually comes back to retest it. So, like when the market made a higher high here and pulled back, when it broke above it, it came back and tested it, moved higher. It broke lower, came back, retested it, moved higher, came back, retested it. So you see the market making this move. Understanding the way the market works, all you just need to do in most cases is actually wait. You know, most newbie traders are very impatient. They want to see activities. They want to, why is he not trading? They want to be trading every single time. But trading all the time doesn't mean you're making money. Actually, in some extent, actually mean you, except you're scalping and you've gotten so good at scalping, frequent trading doesn't equate to success. It doesn't equate to profit. As in most cases, it equates to loss. So this is the reason. This is how you are, apply counter trend line trading. If you have questions on counter trend line trading, so please do feel to drop your questions and we'll answer them as we proceed. Now, the last part of our section today that we'll look at is trade journaling. Now, this is the most, you know, the most annoying part for most traders, especially new traders. They like to think they don't have enough. I don't have time to do all of this. I don't have time to keep a trade journal. But trade journal is very important. Especially if you're starting out. It's a great way to improve your trading by tracking the decisions you make. And then when you track decisions you make, you'll be able to see where you need to make improvements. It's it's really hard. Not hard because it's so difficult. It requires it, but it's hard because it requires you to calm down and pause. And so people don't want to pause. They want to just keep moving. They want to. I'm so busy, Jerry. I don't have time to start writing things down or jotting things down. But it's important if you're going to be a good trader to be able to understand why you took a trade. Because sometimes, if we go back to the market, you would take a trade and if you go after 3 days, you come back, you cannot even explain to yourself why you took the trade. That means you cannot even learn anything from that trade. And I like to say, when I take a trade, I can only win. There's no option of losing. Once I take a trade, I can only win. Is either I win in pips, I make money, or I gain experience. So if I take a trade, there's always something to learn. So even if the trade goes against me, even if it goes against me, I still win as long as I learn something from that trade. So if, for example, in this case, let me look at the current market structure. I'm not saying this is not a trade I'm saying you should go and take. But looking at the current market structure, let me give you an example. Now, if the market is in this current market now, let's just say for whatever reason, I'm looking at this 1 hour time frame and I like, okay, what do I do here? Now, if I decide to sell this pair, sell this currency pair here, and my reason for doing that is because of maybe if you look at here, if I figure out that okay, maybe there's a level of resistance here on the let me look at that on the daily time on the higher time frame. It's not a very serious level. But just for the sake of for educational purpose, let's say I conclude that there's a level of resistance here. And then based on my analysis, I decide that okay, this pair is looking interesting. It has formed maybe a bearish pin bar here. It has also, formed a bearish engulfing bar here, and it is currently trading at a level of resistance. And although this current candlestick has not closed, it is also forming a bearish pin bar. And I decide for this reason, I am going to look to sell this market. So if I look to sell this market and I decide the safe place to place my stop loss would be above the trend line, so somewhere above here. And then my target, let me say I'm targeting the next swing low. Now, if I take this trade, I place my trade, I go to new order, and let me just say I put my stop loss at. I'm not saying you should go and take this trade though. This is just for educational purpose. I'm not selling you USDJPY. If anything, I'm actually buying. Okay, so let's say I decide where my stop loss would be is, let me use this for 66. Let's say my take profits 104.95, so 104, and I sell. Now, what for most traders, this is all they do. So they've done this and they go away. And then what happens is without journaling, you could have the market, break above because the short term movement of the market is actually bullish. Short term, the market is bullish. It's heading higher. You can see if we draw a trend line here, the market has been heading in the direction. Short term, it has been heading higher. Now, if the market breaks, continues and instead of going in my favor, breaks and hits my stop loss, I'd have taken a loss. But without journaling, I would not learn anything from it. So what I do normally, I have a journal. I did a template that I plan to show as an example. Okay, so let's do this. Now, this is what I do. I have the currency pairs. I have, this is quite different from that. But I analyze the market long before anything happens on it. So I look at the weekly outlook. If the market is bullish weekly, I have bullish here. And then maybe if it's bullish weekly and then it's bearish daily, I'll have something like this. And so I would in order to trade this pair, I usually like to have a correlation. So if the market is bullish weekly, I would want to be looking to trade this pair if it is also bullish daily. Then I can now go to the lower time frame to figure out entry to buy. If it is bullish weekly and bearish daily, I may not do anything on the pair. May not. Most likely I would not. But sometimes market is trending sideways and it's also trending sideways. So having an idea of then on the notes, I can now put why I bought. So I'll be like, in this current example we're using, I'll state the reason I bought because trading at current trend line at current resistance level, bullish and bearish pin bar and bearish engulfing pattern from this level. I'll explain in short notes why I place my stop loss here and why I place my take profit here. Now, once the trade is completed, either the trade comes and hits my take profits, or the trade moves against me and hits my stop loss, or maybe it moves in my direction. Then after some time, maybe I close the trade because I see a bullish formation. I will also journal that. So that way, it gives you a bit of time. Like I do this before I take the trade. In most cases, the trades I take are usually pending orders. So once I've placed my pending orders, I go and I do my journaling. So I explain to myself why I bought or why I sold the pair. So this way I can come back and see, okay, if two let's say 5 out of or 7 out of 10 times this same kind of market structure worked in my favor. So I would know that that structure works. So even if it's for the times it goes against me, I would know that okay, this is just one of those 3 times that it does not work. And that way I don't have to beat myself up about when I buy the market is dropping, when I sell the market is rising. But because I'm learning from it, I can avoid making the same mistakes that I've made in the past. And although this would be tough, it's usually is tough for new traders. Journaling is so important to your trading. So invalidation. I have this here because let's go back to our chart. So in this chart, remember why we sold. Invalidation just means what would happen for me to see that that trade is invalid. And in my opinion, for this particular trade, what would invalidate this trade is if I see the market close, maybe something like if the market closes above this trend line. So if the market closes above this trend line, sorry, above this support resistance line, not move above it, but closes above it, and then I might like, okay, it closed above here would invalidate this trade. So what would I do? I might just decide to cut my loss. So here, I would write that close, I'll be like 1 hour close above resistance. and I would have put my note and all of the updates. So if I come back, like if I look at and I'm always reviewing my journal. So if I look at my journal and I look like, okay, although this is not the pair we're looking at, sure, but if I look at, okay, so JPP, USD JPY, let me call this USD JPY just for that sake. So if I look at USD and it says, okay, the invalidation is 1 hour close above this, and I look at my chart, I'm like, okay, the trade is still valid, it's not invalidated. But if it is invalid, I will now look to cut my losses, because if you realize that the trade is now invalidated because of, based on your analysis, you don't need to allow it hit your stop loss. Although you don't want to be quick to, close the trade for loss, but once it has invalidated your setup, you don't need to now allow the trade hit your stop loss. You can just cut your losses. So instead of losing $10, you lose five or you lose four. But once the trade is in your direction and it's still valid, after let's say after this trade has moved on, and that's the beautiful thing about the trade. Let's say we have the market moving in our favor, you can adjust your stop loss. You just need to go back to your trade, go back to your trade. If you're on your mobile phone, it's also there. You just modify or delete order. Adjust your stop loss. You can move your stop loss to so you can, if the market has moved somewhere here, you can move your stop loss to trail the market. And so you can even, if so that in case the market goes up, instead of taking a loss, instead of coming back up here, you would still make a profit. As the market is moving, you're adjusting your stop loss with the market. But you don't want to be quick to adjust your stop loss because the market, like it looked, moves in wave. So imagine if the market moved up to this point, and then you now adjusted your stop loss here, and what will happen is the market will come back, hit you out for loss. For although you take a profit, but it will just hit you out and then continue in that direction. So that is how you apply all of this, and this is important of your trade journal. So when you have your journal, you know what you're looking at, you know what is the current outlook of the market, and then you can now decide to execute your trade. Journaling is extremely important, actually more important than actually a lot of things. So overall, knowing the overall direction of the market on the long term, understanding the direction of the market on the medium term, and then using the lower time frame to figure out entries to the market, just this alone would enhance your trading. Now, I can sit down here and preach about this for all day. I could talk about this. I could show you this same thing on all the currency pairs because the market is, it's just that sweet. But that's because over time I've honed the skill and I've gotten good at it. Now, what you need to do is practice, practice, and practice.